Wall Street concluded a tumultuous month on a surprisingly calm note. As we reflect on the ebbs and flows of the market, it's evident that tech stocks were a significant drag on the trading session this past Friday. The Dow Jones Industrial Average saw a decline of 92 points, which equates to a drop of 0.2%. Meanwhile, the broader S&P 500 experienced a decrease of 0.64%, and the tech-heavy Nasdaq Composite felt a more pronounced slide by 1.15%. Despite these dips on the final trading day of the month, it's essential to note that all three major indices, the Dow, S&P 500, and Nasdaq, marked solid gains for August. Specifically, the Dow climbed 3.2%, while the S&P and Nasdaq achieved gains of 1.91% and 1.58% respectively. This marked a particularly successful stretch for these indices, with the Dow and S&P experiencing a 4-month streak of consecutive increases, the best run they've had in nearly a year. The Nasdaq, on the other hand, enjoyed 5 months of growth in a row, its longest winning streak since early 2024. The recent surge in stock prices can largely be attributed to several converging factors: the easing of trade tensions, better-than-expected corporate earnings, and growing sentiment that the Federal Reserve may soon cut interest rates. However, there seems to be a hiccup in the once unstoppable artificial intelligence sector. For instance, shares of Dell Technologies plummeted by 8.9%, and Marvell Technology faced an alarming drop of 18.6% following earnings reports that failed to meet market expectations. In a similar vein, Nvidia, which is at the heart of the AI trading frenzy, fell by 3.36%. This represented a notable shift for Nvidia, marking its first monthly decline since March. Jay Hatfield, the CEO at Infrastructure Capital Advisors, offered some insightful commentary on this. Expectations surrounding tech companies have reached remarkable heights. While these firms have performed admirably, they may not have done enough to ascend to even greater levels of stock performance. Citi analysts echoed this sentiment in a recent note, stating, while earnings reports were encouraging, the projections for growth related to AI are showing signs of slowing down. Overall, while the market hasn't taken a significant hit, it's clear that some momentum has been lost. To be fair, the rapid pace of gains since April was unsustainable in the long run. On Friday, Wall Street was also analyzing the latest inflation data. Early trading reflected a cautious approach as the Personal Consumption Expenditures Index increased by 2.6% year-over-year for July, which aligned with predictions. A crucial measure, the core PCE, which excludes volatile food and energy prices, rose by 2.9% year-over-year, the hottest pace since February, but also met market forecasts. Chris Zaccarelli, Chief Investment Officer at Northlight Asset Management, remarked, "Inflation is nudging slightly upward, but it aligns perfectly with what we anticipated." As August drew to a close, U.S. stock trading ended on a quieter note, accompanied by lighter trading volumes as the Labor Day weekend approached. Yet the month has been anything but dull for market participants, who faced a barrage of significant developments. From disappointing job reports to the implementation of extensive tariffs under President Donald Trump, and even attempts from his administration to remove Federal Reserve Governor Lisa Cook, the landscape was tumultuous. Yet throughout all this, stock prices have continued to rise steadily, fueled by the anticipation of interest rate cuts from the Fed, stronger than expected corporate profits, and an increasingly cautious but persistent optimism that the AI surge could yield substantial returns for investors. Approximately 98% of companies listed on the S&P 500 have reported their second quarter earnings, with 81% exceeding Wall Street's expectations, showcasing a robust performance. James Riley, a senior markets economist at Capital Economics, summarized the good fortune of the market by saying, "The U.S. stock market stands at an all-time peak, driven largely by rapid earnings growth and expectations for this trajectory to continue." Moreover, comments from Fed Chair Jerome Powell at a central banking forum in Jackson Hole, Wyoming last week hinted at the potential for rate cuts in the near future. While Powell's words raised concerns about a weakening job market, They were met with enthusiasm by investors who eagerly anticipate lower borrowing costs. The Russell 2000 index, composed mainly of smaller firms more sensitive to interest rates, surged by 7% this month, representing its best performance since November. Simeon Hyman, a global investment strategist at ProShares, noted, historically, this particular index is highly responsive to even a small boost from Fed interest rate cuts. Meanwhile, the CBOE volatility index, often seen as a barometer for market fear, has been hovering around its lowest levels of the year, indicating a relative sense of calm and investor confidence. On Thursday, the S&P 500 closed above 6,500 points for the first time in history, marking its 20th record high of the year. Interestingly, historical data reveals that whenever the S&P achieves 20 or more all-time highs by August, there's a staggering 90% probability the index will be higher by year-end, averaging a gain of 5.5%, according to Sam Stovall, the chief market strategist at CFRA Research. The continuous rise of stocks to record numbers occurs against the backdrop of President Trump ramping up his critique of the Federal Reserve. Amid the ongoing uncertainty regarding the feud with Governor Cook, which is now under judicial consideration, market participants remain vigilant for indications of potential developments in this matter. Rob Hallworth, Senior Investment Strategy Director at U.S. Bank Asset Management Group, pointedly stated, "The market is cautiously observing the trajectory of this situation." Additionally, Paul Christopher, head of Global Investment Strategy at Wells Fargo Investment Institute, commented, "We perceive the subdued reaction of the market as a signal that an extended legal dispute might unfold. Regardless, this conflict probably foreshadows larger implications for financial markets moving forward." In response to this climate of uncertainty, gold, often seen as a safe haven, gained approximately 1.2% on Friday, reflecting a 5% increase overall for the month, and marking its strongest monthly performance since April. Known as a hedge against rising inflation, gold typically rallies when investors anticipate interest rate reductions from the Fed. Joe Cavatoni, a senior market strategist at the World Gold Council, stated, "With monetary policy taking center stage, gold continues to be well supported as we move into September. However, while stocks remain near their historic highs, September could bring new challenges." Adam Turnquist, chief technical strategist at LPL Financial, noted that historically, the S&P 500 has seen an average decrease of 0.7% in September, which makes it the worst month for stock performances in the past 75 years. Scott Wren, a senior global market strategist at Wells Fargo Investment Institute, expressed an interest in capitalizing on potential dips. He noted, "We may soon be due for a pullback, and if that occurs, we would lean into purchasing more equities. Ideally, we hope for opportunities to buy stocks at more attractive prices." Looking ahead, September promises to be filled with significant economic data releases. Trading will kick off on Tuesday following the Labor Day holiday on September 1st. Investors will be particularly keen to scrutinize the August jobs report due on September 5th, as well as the Consumer Price Index data slated for release on September 11th.